Silicon Valley Bank's collapse is the second largest bank failure in the U.S. and arguably the first true black swan event for the market since the meme stock craze. But how did we get here? And let's get you up to speed. Julie, there's a lot to unpack here. And I was just tracking a good newsletter, the Daily Upside, and they're noting, coming out of the company's most recent earnings report, that was Silicon Valley Bank, they had mark-to-market losses of nearly $16 billion and only tangible common equity of $11.5 billion.
Okay,
just a major red flag.
I'm going to push the buzzer on you right now.
Go.
You said mark-to-market and tangible book value loss. Okay, let's explain to people what the heck all of this stuff means, because especially folks who were not around during the financial crisis or people who forgot what all of this stuff means, it really does. You have to have a little bit of decoding here, right? And a little bit of disentangling. So this bank started back in the 1980s, and it really was targeted at serving Silicon Valley and serving startups and the tech industry with the acknowledgement that these kinds of companies don't make money until later in the game, right? Over the last decade or so, or even a shorter time horizon, there were just deposits pouring into the bank because we really saw even more of a boom than ever in Silicon Valley, right? You see here what was happening with deposits, followed by a big reversal in those deposits, because we all know what's been going on with the tech industry more recently. And then these depositors got a whiff that there might be some issues at the bank, so they pulled their money en masse. That outflow in deposits happened last week alone, which is just incredible. But the other problem was not just the type of clientele, but the type of assets that this bank was holding on its balance sheet. And that's where we get to the mark-to-market stuff, right?
Just complicated stuff. 95% of deposits were above the FDIC's $250,000 insurance limit.
Right.
It's massive.
It was massive. And again, that's on the depositor side. On the asset side, what they were holding is actually not complicated stuff.
Yep.
It's about as vanilla as you can get. They were buying treasuries, right? They were also buying mortgage-backed securities, which is not quite as vanilla, but they were buying treasuries at a time when we were seeing higher prices and lower yields in treasuries. Then the Federal Reserve started raising rates. That means it put pressure on their depositors, aka their clients, and put pressure on those treasury investments. So when I'm a client and I come to you at Silicon Valley Bank and I say, I want to get my money out, and Silicon Valley Bank looks around and says, I don't have that cash. I have to sell these treasuries. I'm now selling them at a loss, marking them to market, marking them to present value, and marking down their value. So that's where it all came to a head.
At the root cause, higher interest rates.
Higher interest rates on both the client side putting pressure and on the bank itself, its asset, its balance sheet, putting pressure on.
Yep.